Hi, cool. Hey, everybody. Thanks for coming in and joining on this. Scott Fontaine. I work at Ally Financial, and I manage the residual setting as well as the remarketing pricing and remarketing strategy. So I put together a few slides in here that I'm going to talk a little bit about the factors that we find influence values, spend some time on demand factors, talk a little bit about supply, spend some time on vehicle characteristics, and kind of wrap that up with how auto values will influence something like pre-owned leasing. So what drives automotive valuations? Before we get into that, let's talk a little bit about where we are today. So here is our Ally Residual Index, very similar to other indices that we have out there. Manheim produces one, NADA produces one. This is an internal view that we have. You can really kind of see there, graph on the top left, where values are today. Right? Relative to the pre-crisis, where values are still way above where we were pre-crisis. But if you look in those last recent 6 months, values have started to trend down just a little bit. For the year, we found that values have declined roughly 5%. A little bit different than some of the other indices we have out there. One of the things that we do here is we'll adjust for MSRP. Right? This index is adjusted for mileage, mix, seasonality, and those types of things. When we get into some factors that influence that and drive values, macroeconomy is the first thing that comes to mind. So there on the left is GDP. Really see that strong correlation between GDP and used car values. On the right there, the unemployment rate, demand factor. Here we specify unemployment rate not as the level of 4.5% or 4.6%, but really the change. You can really kind of see how the unemployment rate as it is changing is driving differences and changes in used car values. Really kind of see there during the course of the crisis, unemployment rate spiked up and it ran up pretty quick. Used car values were dropping just as quick. As the economy started to normalize, folks were finding more jobs again, values increased appropriately. Gas prices. When we first looked at gas prices, look at the graph on the top left, gas prices versus used car values. We see kind of a mixed results. There are periods of time when gas prices are positively correlated, periods of time when it's negatively correlated. We really couldn't make a whole ton of sense about it. But then when we looked at it on a segment level, we saw a strong correlation. Look at the graph on the top right, small cars. As gas prices go up, so do small cars in terms of their values. Bottom right-hand side, large SUVs. Strong negative correlation. Low gas prices that we're experiencing today have been a boon for large SUVs. Just one of the factors that's driving SUV prices. And you kind of see where we are right now. Look at each of the graphs in terms of the red line. Gas prices right now are at roughly a 10-year low. Seasonality. This shouldn't be news to a lot of folks in the room. March. After we adjust for all the other factors that influence used car values, we see March as being a peak. As folks are getting their refund checks from tax time, they're out there spending that on used cars. See, as we move past March, still got strong strength during the summertime. And as you move into August and September, every vehicle on the road gets a birthday, and values decline in through the winter. When we look at other segments, four-wheel drives, it's almost the opposite of this. Wintertime, it's almost like an inverted U. Wintertime's especially good for four-wheel drive vehicles, especially on a regional basis in the Northeast and other climate-impacted areas. Sports cars are peak during the summer. So lots of differences. Supply. Lots of stuff in the press right now about supply, the oncoming wave of used car vehicles. Here we look at supply as vehicles between 3 and 5 years old, or up to 5 years old. And that's the red line. It's an internal calculation that we have, and it's really based upon vehicles that are produced today, whether they're fleeted or leased or sold through retail channels. They are the future of used car supply. And if you look at that used car supply in terms of the way that we're calculating it, we're already past pre-crisis levels. So the supply is coming online today. And you kind of see that strong negative relationship between supply and used car values. we find that supply, and in terms of our internal modeling, is one of the biggest drivers that we're seeing in terms of valuations today. Now, not all supply is created equal. We take a look at diving into it a layer deeper, looking at different segments. Here we kind of broken it out by fuel-efficient vehicles and less fuel-efficient vehicles. If you look at some of the fuel-efficient vehicles, small cars and small mid CUVs, we really see that supply for them has well outpaced what used car supply was pre-crisis. It's on an upward trend. Look at the graph on the right. Less fuel-efficient vehicles. Large luxury CUVs, pickup trucks, large utilities. Less fuel-efficient vehicles have not only had the benefit of lower gas prices today, but they also have relatively lower supply. And it's almost a double whammy for fuel-efficient vehicles in terms of their impact. So what are values doing for those vehicles? It really shouldn't be too much of a surprise. Fuel-efficient vehicles are suffering from higher amounts of supply, and gas prices are at 10-year lows. We kind of see strong separation between values just in the last several years of those fuel-efficient vehicles. Less fuel-efficient vehicles, I don't want to call them gas guzzlers, but less fuel-efficient vehicles have had the benefit of lower gas prices and the benefit of lower amounts of supply. Switching gears into some vehicle characteristics, we spend a lot of time focusing on the production cycle. Vehicles, when they're first released or newly redesigned and refreshed, they hold value the highest amount that they will throughout their life cycle in that first year. Right? It's new, it's hot, it's fresh, it's exciting. Then the second year of the production run, we'll retain just a little bit less. And we kind of see that transition occur throughout each of the years since the vehicle's been redesigned. By the time you get into the third, fourth year of the production run, it's gearing up to be redesigned again in the next few years. It's been out on the market for a while. It's lost a little bit of its luster, and we're seeing that show through in the valuations. When the vehicles do get redesigned, we see almost an immediate hit in terms of values. You see that transition as they're going through, aging throughout the product line. When you compare 3-year-old values of a vehicle that's still in production versus one that has already been redesigned, there is a measurable difference between them. And that difference is kind of consistent as we look at different ages of the vehicles. Fleeting, other vehicle characteristics. Shouldn't be any surprise to the folks in the room that vehicles that are higher on the fleet penetration are going to have lower retained value. Manufacturers are pumping them out, shooting them into rental fleets. They're also coming back onto the market in shorter cycles, right? So these fleet vehicles are coming back every 12, 18, 20 months. So the more of them, then the more of them there will be in the auction lanes competing with other vehicles. So, kind of spent a few minutes talking about some demand factors, some supply factors, and some vehicle characteristics. So where are we headed with this? So let's think about some things that we can predict. Supply. Like I said earlier, every vehicle that's produced today was produced last month, was produced last year, and the year before that. That is the future of used car supply. There's really not a lot of supply that will get injected into the marketplace. It's already online. It's out there. People are driving it. And whether it's a company that has a fleet of vehicles, they're getting ready to churn that over. Lessees are coming up on their maturities. We know that. It's identified and defined. And what does that look like going forward? We have a negative impact from that. Supply is at the highest level it is now, and it's going to continue to grow through the next couple of years. What does the industry think it can forecast? Some factors we use: unemployment rate, GDP, gas prices. Unemployment rate's pretty low right now. Really not going to get too much better. I think a lot of the forecast I've seen kind of shows for it to get slightly better. That's going to have a marginal beneficial impact. GDP, positive. And gas prices could go up, could go down, but the impact there is going to differ by the segment, not necessarily across the used car values as a whole. And what can't the industry predict? OEM behavior. OEMs, if they were to churn up the crank, start overproducing their vehicles, putting them into fleet, offering incentives, those types of things, that could have a very negative impact on values, especially the ones within their own brands. And that's one of the things when we start looking at what can we forecast, what can't we forecast, OEM behavior is probably one of the toughest ones to get our arms around. So what does auto valuations have to do, not have to do, but what are the impacts of the auto valuations having on pre-owned leasing today? So when we're looking at pre-owned leasing today, lots of factors are influencing it. But one of the biggest things that we're finding is used car leasing has not taken off, has not gained a lot of the traction I think a lot of the folks thought it would have as we head into this year. And really one of the biggest things is that used car lease is competing with retail transactions. And what's happening with retail transactions is term lengths are starting to get a little bit longer, and those monthly payments are dropping. And so the used car lease is having a tougher time competing with that. And if you look at those used car leases, they have a lot of factors that are built into their initial residual. Not only do they have standard age depreciation, they also have the expected market depreciation. So as we expect the market to do certain things over the next couple of years, that's all going to be baked into that residual. And is going to make it, one has an outlook of lower used car values in the future, that's going to make the residual lower and will drive up the price of the used lease payment, excuse me. So expectations of higher values or flat, that will have an impact on used car leasing. The residuals will be higher vis-a-vis those that have the expectation of lower residuals. And the trajectory of that decline will drive the factors that were put into the residual value and the impact on leasing payments. So a few slides in there. This kind of concludes the presentation that I had. Really kind of covered a lot of the factors we had on macroeconomy, supply, demand, used car values, and the outlook on there. Great. Thanks.